Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're going to be embarking on our first part of our advanced options master course, which is going to be on the topic of about how to manage options positions. So this is assuming that you already have a variety of different scenarios that you might find yourself in, and talking about how do you manage your options positions through winners, through losers, and other types of strategies like cover calls and cash secured puts. So we're going to cover a variety of topics, but this webinar is really designed to help you understand the psychology around trade management. More importantly, how do you think about managing your winners? How do you think about managing your losers? And a lot of it actually gravitates around how do you manage the losers, because that's really where I think as a market strategist, I've seen people mismanage their positions once they have a losing position. And many times that's really what causes most trading accounts to unravel. It's when you have a small loser, you try to fix that small loser and turn it into a winner. Next thing you know, you're in a bigger loser, and that sometimes can be a slippery slope. So we really want to talk a lot about how to manage risk first before we can talk about how to manage winners. I will say managing winners is, in my opinion, easier from an emotional perspective. So I want to talk about a little bit about just the emotional side of trading, talk a little bit about psychology, because at the end of the day, we are humans, we are not robots, and we can't just necessarily always follow rules to a T. So I want to discuss some of those things and how you can handle this, at least from my experience as a market strategist. So those are the things we're going to go over here today. Before I get started, just a quick disclaimer: what we're going to discuss here today is purely for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. And for those of you that are brand new to OptionsPlay, for those of you that recently discovered us through the Options Education Day that we just hosted last month, if you don't already have access to OptionsPlay, you can sign up for free courtesy of the Montreal Exchange at optionsplay.com/TMX. I'll post that link into the chat window, which you should pull up at this point right now if you're joining us here today, because you're going to be participating by typing into the chat window. You can find your chat window at the bottom of your screen. Just click on the chat window to bring that up. Access to OptionsPlay will bring you not only the platform itself, but also a wealth of tools along with that, with options education webinars that we do every 2 weeks, on-demand video library. We put out Monday, Wednesday, and Friday weekly cover call reports, which include things like liquidity as well as the earnings calendar, so that you can know that which symbols to focus on, what earnings are coming up. Very important for options traders to have access to these types of reports, and they're delivered to your inbox every Monday, Wednesday, and Friday. So it's all free of charge. Just register using the link that I just posted into the chat window. So today we're going to go over, first of all, I want to talk a little bit about position management philosophy. I want to talk a little bit about how do you go about thinking about winners and losers, because it's so important how you think about it to determine how successful you are as traders. And this is something that I've discovered as a market strategist. You know, I've been working as a market strategist for 13 years, and I've seen just about everything in terms of strategy, in terms of account successes, account blowups. So I want to share with you some of what I've learned to hopefully help provide some insights as to how to avoid some of the mistakes that many times causes people to blow up their accounts. Then we'll talk a little bit about some of the rules that you can use to keep your losses small, and only when you are able to keep your losses small do you even have the opportunity to hit home runs, to really knock it out of the park with your winners. So it's really important that we first understand how to manage our positions from a philosophy perspective, how we keep our losses small before we can even think about really looking for the upside. I tend to find that most investors, when they first start out, what they do is they focus too much on this, and they don't pay attention into keeping losses small. They don't pay much attention into psychology and philosophy of trading. And this is really where you basically blow up your account and don't have enough capital to even hit home runs. So this is really why I want to spend so much time focusing more on managing risk first before we talk about what upside is available, because the upside's not going to be there if you don't have a trading account left to trade with. And then we'll talk a little bit about cover calls and cash secured puts. This is a strategy that, and many of you, if you have sold cover calls over the last few weeks, you might find yourself in a position where you're trying to figure out whether you want to roll those cover calls, if you want to let your stock get called away. So we'll talk a little bit about how to manage those. We'll go through some examples of winners and how to manage those winners before we talk a little bit about questions and answers and try to answer any questions you have regarding the things that we're going to go over here today. So a lot to cover, a lot to unpack, so I want to make sure that we have the time to go through it. So let's go ahead and get started with that. So first of all, I'm going to start off with a quote that I think many of us as traders may be able to relate to or have found ourselves in a position, because this is the type of question that I get all day long. And I think what this reflects is the wrong way to go about thinking of trading. And the frequency at which I get asked this type of question leads me to believe that most traders that are asking this type of question are focused on the wrong thing. So I get a lot of questions asking from traders something along the lines of, I've placed an options trade, whether it's a bullish, bearish, no matter what type of strategy it is, but it's turned against me, meaning I'm now in a losing position. And the question that I always get asked is, how do I turn this into a winner? How do I turn this around? And the answer to your question, first of all, is that there's no magic bullet that turns a loser into a winner. If there was, everyone would be doing it. The second problem that I tend to have with this question is that what it tells me is that people have an aversion to losing. People have an aversion to taking a loss. And that many times is what leads to big losses, is the fact that people don't want to take a small loss, and they'll do everything possible to avoid that small loss. And in trying to do so and trying to avoid that small loss, they actually end up ironically in a much bigger loss, because anything that is going to help you turn a losing trade around, generally speaking, is going to require you to take on more risk. And that's the last thing you should be doing in a losing trade, is taking on more risk. You should be doing everything you can to reduce risk when you have a trade that's going against you. And that is the first thing that I think everyone here, that's even regardless of whether you're an experienced options trader or you're a brand new options trader, you should start learning, is to, if you have a trade that's gone against you, accept the fact that some trades are going to lose. You're not going to be able to win every single trade. And I know there are people that constantly try to pursue that. I know people that constantly try to pursue 80, 90% winners. And what they don't realize is, in the pursuit of that, they're actually putting themselves in substantially more risk than they originally anticipated. If you can associate with this by any means, please type 1 into the chat window, because I think this is really what sets apart someone who's an experienced options trader, someone who's been doing this for years and has been able to be successful at it, from options traders that really struggle to become profitable in trading. Is they may have a string of winning trades, but all it takes is one bad trade that blows up most of their previous trades. And I think everyone who's traded options has at some point found themselves in this scenario. And the goal of this webinar today is to make sure that you walk away with a plan as to how to slow that process, how to prevent that from happening to your trading account. So many of you that have experienced options trading will understand, at least from my psychology perspective, what I mean by this. And for those of you that are brand new to options trading, I hope that this is a new revelation to hopefully becoming a more profitable trader. So the first thing I'm going to do is talk a little bit about, I've been a market strategist for 13 years. I started at a company called Forex.com. And for those of you that have ever traded currencies, you're familiar that currency trading involves a high amount of leverage, or access to a lot of leverage. And I've seen a lot of spectacular trading accounts. I've seen some spectacular trades. I've also seen some very spectacular blow-ups, people blowing up their accounts using too much leverage. And I've seen so many different types of strategies. Technical analysis strategies, fundamental strategies in Forex, in futures, in equities, and options. So I've at this point have spoken to thousands of traders and looked through their accounts and tried to help them through their trading. And the one thing that really sets professional traders or successful traders apart from everyone else is really how they think about their losers and how they think about managing risk. And the example that I want to show, everyone is this particular chart. And this is just meant as a representation of what many times we may have done, something that we have traders may have done at some point in our trading career. Hopefully, this is something that you only do once or twice and you learn from that and never do it again. But unfortunately, I tend to find that this is a scenario that many traders find themselves in over and over again, which is, here I have a stock. It's a stock that for multiple times bounced off of a support level. Let's call this $26 support level. And you think to yourself, this stock's bounced off of 26 multiple times. That's always a good place to buy the stock. So you purchase some stock, or maybe you buy some call options at 26. The stock moves initially a little bit higher, but starts to then move lower below that $26 level. And you say to yourself, okay, this trade is not going in my favor, but I don't want to take a loss. And I see so many traders in this type of mindset that say, I don't want to take a loss. What can I do to get myself back to break even? And again, this is the slippery slope that causes much bigger blowups, much bigger losses. And again, big losses is what causes you to not be able to have enough capital to try to hit any home runs. It's these slippery slopes. So it's so important that we try to remember this the next time this happens. But this is something that happens to everyone, in my opinion, when it comes to trading, which is, I made a trade, it didn't go in my favor, so let me see what can I do to get myself back to break even. And at this point, what you do is you completely forget about why you bought the stock in the first place. You bought it because it was at $26 support, now it's well below that support level. You start looking for new justifications for why you can buy more, or maybe buy another call option. So you say, well, let me look back a little, and you say, well, guess what? Looks like there's some real support back here around 22. Last time it went down to 22, the stock really rallied from there. So let me see if I can buy some more, because if I buy some more at 22 and the stock bounces even a little bit back to 24, I'm at least at break even. I won't lose any money and I'll get out. And you do that, and next thing what happens is that the stock doesn't quite make it to 24 and keeps going lower. Now, if you can relate to doing something similar to this in some fashion, please type 2 into the chat window. I know I have, and I know most traders at some point have tried to do something like this. In the effort to prevent a small $2 loss, now you've added $2 more worth of risk, and maybe when the stock turns around, instead of just losing $2, now you're down $6 or $8, right? And depending on how big the initial trade was, sometimes if you traded really small, you'll say, okay, you know what, I'll let this go at this point. But sometimes you got into such a large trade to begin with, you start to get to the point where you're kind of what poker players call pot committed, meaning you've risked so much money at this point, you really can't afford to take a loss. So now you're thinking to yourself, now you're starting to get a little desperate, right? Now you start looking for other reasons as to why perhaps you can buy a little bit more and maybe get back to break even. So you start looking at some oscillators. You say, well, this stock is really severely oversold. It's got to bounce, right? Look at stochastics. Every time it got under 20, it bounced, and you got the really nice move higher on the underlying stock, right? So you start to look for new reasons as to why you want to buy the stock. So maybe at this point you buy a little bit more, only for the stock to move sideways and start to move lower. And at some point, this really becomes a bit of a disaster. And this is really how the start of any type of account blow up starts, is something along these lines, right? And again, for anyone who's been through this enough times, you learn from that lesson and you say, okay, I'm not going to keep chasing these types of movements, and I'm going to prevent myself from blowing out my account. And I hope that many of you that have experience trading will learn this. And for those of you that are new to options trading, I hope that this is a lesson to hopefully help you avoid this going forward. So I don't know if I really had a chance to talk about this very much, but it's one of the most important things, in my opinion, for trading that has nothing to do with trading. It just really has to do with how you view trading. Or nothing to do with your strategy, but how you view trading as a game, right? And this is written. There's a book called Finite versus Infinite Games, written by an author called James P. Carse, who is not a trader, is not a professional in terms of finance. He was a religious philosopher, but he came up with this theory that there's two types of games. There are finite games and there are infinite games. Finite games are the games that we are all familiar with. These are games that have fixed rules in terms of what you can do and what you can't do. The game always ends at a certain point, meaning there's always a point at which the game ends. And at the end of that game, there is declared winner or loser based on the rules that are put together for this game. An example of a finite game are the ones that we're all familiar with, like football, basketball, playing blackjack. These games have rules, they have an end, and at the end you have a winner or a loser. So this is a finite game, right? It's very simple to understand, and I think most people think of these types of games as ones that we play. And then there's the type of game that are called infinite games. And this is the type of game that we usually don't think of a game, but really, if you think about it, it's not too different from it. There's just a different type of game. And an infinite game is a game that has really no agreed upon rules. And it's a game that never ends. And there's no such thing as a winner or loser in an infinite game. You either have players, meaning people who are still in the game, or people who are forced to drop out or cannot continue to play that game because they no longer have the resources, they no longer have whatever it takes to stay in the game. Right? An example of an infinite game is, I think a good example of that is starting a business, right? When you start a business, there's no such thing as winning, right? You either are in business or you're out of business. And there's no such thing as the end to it. There's no end goal. The goal is just to stay in business, right? Same thing as running the National Football League compared to a game like football. So football is a finite game inside of an infinite game, because if you're Roger Goodell and you run the National Football League, and maybe in Canada you're thinking about a Canadian Football League, right? When you're running a football league, there's no winning in that. There's only you are a league that's still in play, or you are getting pushed out by a better league, right? Same thing like running a casino. There's no such thing as winning when you're running a casino. You're either operating or you're not operating because you no longer are generating enough revenue to stay in business. And guess what? Trading, even though we think of many times trading as winning and losing, and many times the way that I see traders question each trade and think about winning and losing, what it sounds like what they're doing is they're playing a finite game. But in reality, trading is not a finite game. It's an infinite game, because there's no such thing as winning in trading. You can win in a specific trade, but there's no such thing as winning when it comes to trading. You either have a trading account still available with enough cash to place another trade, or you've blown up your account. You no longer have enough capital to continue trading unless you deposit more money. So I want to make sure everyone understands the distinction between a finite and infinite game and how it applies to trading. So if that makes sense to you, please type 3 into the chat window. And there are plenty of resources. I want you to, after this, to Google this. If this is a brand new concept to you, I highly recommend that you take the time after we finish here today and Google finite versus infinite game and see how it applies to so many other things in your life outside of trading, outside of this specific example, because it really does. When you realize what type of game you're playing, you start to think about what do I care about? Because when you're playing a finite game, the only thing that you care about, when you're playing a finite game, the only thing you care about is winning, right? There are sets of rules to the game that tell you exactly what you need to do in order to win, and you're doing everything you can to try to win. When you're playing an infinite game, guess what? Your goal is not to win. Your goal is to make sure that you don't drop out. That's your only goal in an infinite game. Your goal is to do everything you can to increase your ranking within the infinite game, but also at the same time, your goal is not to win. Your goal is to make sure that you don't blow up your account. And Jim said marriage is an infinite game. That's an exact example of an infinite game, that even though many times, I'm married, and sometimes you have a fight with your significant other, and you think about, did I win that fight? Did I lose that fight? But guess what? At the end of the game, at the end of the day, it doesn't matter whether you win or lose a specific fight. The question is whether you're married or you're divorced, right? And once you realize that, that's when you completely shift your thinking. And trading is no different. Trading, your primary goal, and this is what I've observed as a market strategist over the last 13 years, is the best traders are not the ones that are worried about how much money can I make. They're worried about how much risk am I taking, because how much risk they take depends on whether or not they're going to stay in the game. And that small shift in thinking, it's not difficult. It's not something that's difficult to grasp. It's just something that's very difficult to implement, in my opinion. Because once you realize that you're playing an infinite game, you start to realize that I'm completely optimizing for the wrong thing. And if you keep focusing on winning, that's when you're going to become very, very frustrated as a trader, because there's no such thing as winning in an infinite game. The only thing that you need to worry about is, am I still in the game? And what can I do to make sure I stay in that game? And the rules for that is really, really simple. The rules for how to manage and keep your losses small is to trade small. The rule of thumb that I always tell every single options trader, no matter whether you're a beginner or an advanced options trader, is to never risk more than 1 to 2% of your account per trade. And there's a few reasons for this. There's a whole mathematical reason as to why you want to keep 1 to 2% of your account per trade, just because of the law of large numbers, but also from an emotional perspective. When you're only risking 1 to 2% of your total account, you tend to be less emotionally attached to that trade. When you risk 10% of your account per trade, guess what? You're going to have an emotional attachment to taking on that loss. Because guess what? The market doesn't care whether you're right or wrong. You're going to win some trades, you're going to lose some trades. You better not be emotionally attached to that win or loss, or else that's when you get yourself into trouble. Because when you have an emotional tie to a trade, that's when you're likely going to find alternative reasons as to why you're right and try to prove the market wrong by adding on to that trade and proving yourself correct. But guess what? You get nothing out of proving the market wrong or market right. The only thing that you need to do is make sure that you prevent your account from blowing up. The best way to do that is make sure that you risk no more than 1 to 2% of your account per trade. The second thing that I think is very distinct, that's very distinct between professionals and successful traders versus everyone else, is really the plan that they have before they get into a trade. So 2 things that you absolutely should have with respect to managing your positions. Number 1 is having what we call a trade thesis plan, meaning a plan as far as why you're getting into the trade and when you would consider yourself either correct or incorrect. So in the example that I gave before, I entered the trade because I thought that $26 was a support level, right? So my thesis is that $26 is a support and it will hold. Once the stock breaks below that $26, I should consider my thesis, my view that $26 is a support level. I should be able to consider myself wrong and say I was wrong and get out. It's a hard thing to swallow to say that I was wrong. It's a hard mentally emotional thing to get over, but that's the thing about trading, is that guess what, you're going to be wrong a good portion of the time, and you better get used to that, or else you're going to find yourself in trades like this where you're attached to a trade and attached to being right. But guess what, no one cares about if you're right, and certainly your portfolio doesn't care whether you're right or wrong. The only thing your portfolio cares about is whether you're making money or losing money. And if you keep pulling the trigger on things like this, guess what? You're going to lose money and you're going to blow up your accounts. And the goal here is to prevent that at all costs. Does that make sense to everyone? If that makes sense, please type 4 into the chat window. So at this point, we haven't talked about strategies. We haven't talked about options. We haven't talked about anything. This is just pure psychology that will help you for your options trade, okay? So now that we understand psychology, and hopefully this gives you some insight, and again, I really hope that some of you take the time and just Google finite versus infinite games. There have been fantastic speakers that speak to this type of theory and how it applies to so many other things outside of your life, like to running a business and just how you think about running a business, how you think about your marriage. I hope that you guys are able to benefit from that as well in other aspects of your life, including trading. So having a trade thesis is something that's really important before you get into a trade, because if you don't have a trade thesis, you're never going to know when you're incorrect, right? If you don't really think about why I got into a trade, then you're not going to be able to know when you're wrong. And if you don't know if you're wrong, you're never going to be able to take a small loss and move on to the next trade, right? Because in the first trade that I gave you, once the stock broke below 26, that should have been an easy thing to say, okay, I was wrong, cut my losses and move on to the next one. Because the reality of it is that most professional traders, in terms of how well they can predict the direction of a market, is usually somewhere about 60%. You know, a good trader will be able to tell the direction of the market roughly about 60% of the time. Maybe a really good trader in the 65% of the time, which means that they're still wrong 35 to 40% of the time, right? Once you realize that even a great trader is wrong 35 to 40% of the time, you start to realize that, hey, I'm not so bad at trading, or maybe I'm not so bad at realizing where the market goes. I just have to know that those 35 to 40% of the time that I keep my losses small, and the other 60% of the time, if I am correct, how do I manage my trades into being spectacular winners? That's the recipe to success. And that's exactly what I'm going to teach you here today. But before I can teach you that, you have to first accept the fact that 35 to 40% of the time I'm going to be wrong, and be able to you have to have the ability to take a loss, especially a small loss in that event, so that you have the opportunity that the other 60% of the time that you do try to hit some home runs. But in order for that to happen, you have to first be able to manage your losses first, okay? So it's really important to know that when you're incorrect, so that you can pull the trigger on cutting a loss and moving on to the next trade. And at the same time, know when you're correct so that you can take a profit, okay? So knowing, what your thesis is, so that you clearly know I'm right or I'm wrong, so that you take a profit or a loss. Now, I will say, when you use technical analysis, when you're correct or when you're incorrect tends to be somewhat objective, meaning when I say that there's a $25, $26 support level, it either breaks below it or it doesn't, right? That's a fairly objective view. But if sometimes when you have a fundamental view, like I think this stock is undervalued, right? That's a hard thing to say when you're wrong or when you're right? Because you could say that the stock's at 100, I think it should be valued at 200, but when the stock drops to 95, is it still undervalued? Are you still correct in the fact that it's undervalued, or are you wrong? So, depending on the type of analysis you do, certain analysis is very clear cut. Other ones are not. Be aware of that, right? Because when you're trading something that's not as clear cut, it's harder for you to be objective to say I'm right or if I'm incorrect. So the second thing that you can do is have a plan based on P&L, meaning based on the profit or loss on a specific trade, because that is something that's very objective, right? You're either down $100 on the trade or you're up $100 on the trade. There's no subjectivity to that. So you can instill some rules around that as well. So generally, the rule of thumb when it comes to options trading is to cut your losses when you've lost anywhere from about 50% of the premium that you've paid for an option, because generally by that point, the trade is not working in your favor, and the probability of that trade coming back in your favor is pretty low at that point. So it's best at that point to turn maybe something where you risk 2% of your account per trade. If you cut your losses at 50%, now you've lost 1% of your portfolio, and guess what? You still have 99% of your portfolio left to place your next trade, right? But if that's only if you are able to cut your losses at 1%. If you instead hold on to this trade where, instead this trade turns into a 5% loser, now you only have 95% of your account left for trading. Now, 95% is still a large percentage of your portfolio, but all you have to do is this a few times, and guess what? Now you've significantly reduced the losses on your portfolio. And this is, again, that's a slippery slope that I see a lot of traders fall down, and that's really where it turns from a good trade into a complete disaster. So at all costs, your goal is to prevent that so that you can shoot for that upside, okay? You always should never, ever double down or increase portfolio risk, meaning if a trade is going against you, cut that loss, move on to the next trade. If you want to trade another trade on the same symbol, that's fine, right? If you want to cut your losses on this losing trade and get into a brand new trade, do that. But don't confuse the new trade with the losing trade. I always tell users, especially, in trades where you might want to place another trade on the same symbol that you have a losing trade, I always tell users, if you weren't in a losing trade already, would you place another trade on that symbol? 9 out of 10 times, you'll find that the answer to that question is no. If the answer is no, you should not be trading another time. Many times you're trading it just because you're in a loser and you're trying to get yourself back to break even. That's why most people will trade a second trade after a losing trade on the same symbol. But, once in a while, you do find yourself in that opportunity. If you do, great. Cut your losses on your first trade, place a brand new trade. Remove your emotional attachment to that losing trade first before you get into your new trade. Hopefully that helps you prevent yourself from, again, going down that type of slippery slope. You generally want to take profits at usually somewhere between 75 to 100% gain. This is designed to give you, again, an objective point as to when you want to take profits. So even if you're not quite able to figure out whether you're correct or incorrect, you have some objective views so that you know, hey, it's time to cut my losses, or hey, it's time to take profits. You always want to try to take partial profits when possible. So whenever you're trading multiple contracts, whenever you have the opportunity to take some profits off the table, that's always good practice, so that you reduce your risk on the trade by taking some of those partial profits, and then you still keep a remaining portion of your position for further profits down the line. That's the best practice for reducing risk, and then still maintaining that potential upside potential. And what we're going to spend a bit of time today is talking about how to roll your positions up or out so that you can extend your targets, you can extend your time frame, and you can even extend your magnitude when a stock does move in your favor. So most of the time today we're actually going to spend is on talking about how to manage winners, because managing losers is actually fairly simple. You should simply just cut your losses and move on. And I hope that that's what you guys take away from this, okay? So if that makes sense to everyone, please type 5 into the chat window, and I'm going to go through the details of how to actually trade the plan that I just showed you here today. Okay, perfect. So I see a lot of 5s. So now that we talked about the simple rule of thumb when it comes to when a trade goes against you, either having a plan based on your thesis, saying that I'm wrong, get out of the trade no matter how much you've lost, whether it's 0.5%, 1%, 2%, whatever percentage you've lost. Once you've said that I'm wrong, get out of the trade. Or if you have a target from a stop loss perspective, getting out. Those are your 2 primary rules for getting out. When it comes to when a trade goes in your favor, now you have a lot of options, because when a trade goes in your favor, there are a lot of things that you can do to turn that small winner into potentially a huge winner. And that's really what turns trading accounts around. That's really what allows you to really have upside in an account. But the first thing to do is to first manage your losses. So today what I'm going to do is I'm going to give you some examples. And when I say I'm going to give you examples, what I mean by that is that there are so many different ways that you can trade what I'm going to show you. There are so many variations to what I'm going to be doing. This is meant to help inspire you, and this is meant to show you the possibilities of what you can do when a trade works in your favor. And this is really where you should be focusing your attention on, not how do I turn a small loser into a winner, but how do I turn a small winner into a significantly larger winner. If you just focus your attention on that, I promise you will become much more successful as traders if you can just first let go of those small losers. If you can let go of small losers and keep them small, and then spend most of your time focusing on how do I turn my small winners into big winners, that's when you're going to be able to hit home runs. And that's what we're here to talk about, okay? So I hope that this is exciting for you guys, and I hope that this helps shift your brain cells, because a lot of times I think most traders spend all of their time managing their losers, and they don't really spend too much time thinking about how do I manage my winners. Versus here, what I'm trying to do is say, don't spend your time managing your losers, just cut them, and then spend all of your time managing your winners. And this is how you can do it. So first example, I have stock XYZ that's currently trading at $100. And I think the stock is going to go higher. I think it's going to go to let's say 110. And maybe I should use a different color here. Let me use green to make it a little easier for you guys to see. So let's say I have a $100 stock, and I think the stock is going to rise to, let's say, 110. Whoops. Whoops. Let me do this. Let me change it back to red. Probably a little easier to read. So let's say I have a $100 stock. I think the stock is going to rally to, let's say, 110. So I'm going to buy a call option here. So let's say I buy 10 contracts of a $100 call option. So the at-the-money call options, and let's say these call options cost $3 to buy. So 10 contracts of this will cost me a total of $3,000 to buy 10 contracts of a $100 call option. And I have a target price of 110. So let's say in this particular case, the trade starts to work in my favor, and the stock moves from 100 to 105. And I still have 3 weeks left to expiration. So the goal here, so the premise here is that I have a trade that goes in my favor, but it hasn't quite reached my target price, and there's a fair amount of time left between now and expiration, meaning it's not just expiring the next day or two. So this is an example of what you can do with options that many times as options traders we might not have thought of, but what you can do with your position that can help you manage your positions and turn this small winner into potentially a much larger winner. So the first strategy, and this is a fairly simple one, is to, when a trade goes in your favor, and especially when you're trading multiple contracts, is to close half the position in this particular case. So let's say I sell 5 contracts of the 10 that I purchased. Now, because the trade has gone in my favor from 100 to 105, my call options that I bought for $3 are now going to be worth more. So let's say they're worth now $6 because the stock has now moved $5 in my favor, so my call options are worth $3 more. So what I can do is I can sell half my position in this particular case for $6 each. So what that does is it brings in a total credit of $3,000. And what that does is it keeps my 5 remaining contracts of that $100 call option. So what I've done is I've closed out half of my position for a partial profit, and this allows me to keep the other half of my position for free. Because I've received a $3,000 credit on selling half the position, I only risked $3,000 to begin with. So now my total risk went from $3,000 down to 0. But I still have half my position. Now at this point, the stock can go either way, right? It can still go up to 110 by my target date, which is 3 weeks from today, or this trade can completely turn around for me and maybe the stock plummets back down to 100. So what I have are effectively 2 possible scenarios, right? In the best case scenario, now I can maybe when the trade goes up to 110, I can make an additional, let's say $2,500 because I still have 5 contracts. If the stock goes up to 110, I would make $500 a contract. So my best case scenario, I'm making $2,500 in this particular case while risking 0 because I've reduced my risk down to 0. So it's free money, if you will, that I'm making at this point. And in my worst case scenario, if the stock plummets to $100 or less, guess what do I risk? I make $0 in this particular case. So what you've done is you basically took a trade that originally risked $3,000 that you might have been able to make, let's say $5,000 or $6,000 into a trade where you've risked $0 and you can make maybe $2,500. Now, this is really how you start turning small winners into huge winners, by turning in a trade that is starting to go in your favor and completely reducing the risk down to 0 or close to 0 in many times. And sometimes you might be able to even make a small profit because maybe you can sell 5 contracts instead of for $6. Maybe it's worth $7 or $8. In this particular case, by selling half your position, you're not only reducing your risk, you're actually taking a profit on the trade and still keeping a portion of your position to make even further profits. This is really how professional traders hit home runs on their particular trades. But you can only hit home runs, again, if you focus on keeping your winners small. Your losers small. So focus your attention on how to trade strategies like this. And this is just the first example of many that I want to give you here today as to how you can turn small winners into huge winners. And this is just a simple one where the trade has gone halfway in your favor. You think it can still go in your favor, so you want to reduce your risk down to 0 or close to 0 and keep on maintaining the half the position for that initial move. But in the event that the trade does go against you, and we've seen it so many times, right, where a call option goes in your favor and then all the profits evaporate because the stock turns back against you. And that's really where time decay can really hurt because you've got the initial move, it didn't quite go as far as you wanted to, and you didn't take profits, and all of your profits evaporated. Now you've lost $3,000. This is designed to help prevent those cases so that you don't lose $3,000 when the trade goes against you. The most that you can lose at this point is maybe $0. And there are so many examples of trades that you might make that fall under this type of category. So if this makes sense to you, please type 6 into the chat window. Okay, perfect. I see a lot of 6s. Now, there's so many variations to this too, right? You don't have to sell half your position. You can sell a third of your position or 3/4 of your position. You can make modifications to this. You don't have to just trade exactly what I'm doing. And today, this is meant to help inspire you to see what different variations that you can do from this, right? The second example that I want to give you is the same example. Let's say I have a $100 stock. I think the stock is going to rally. And let's say I think it's going to rally to 110. And let's say when I buy the call option, I buy 10 contracts of the July $100 call options. They cost $3. So in the same example here, I'm spending $3,000 on this particular trade, and I have a target price of 110. So let's say I have this modest directional move in this particular case from 100 to 105. And there are still 3 weeks left to expiration. But maybe at this point, this time is a little different because now I have new information, right? Between the time I bought it and the time now, maybe some new information came out where now for me to think that it's going to hit 110 or whatever target price that I have, now I feel that, you know, the stock didn't move as fast as I wanted to, and I feel that I'm going to need a little bit more time. And I think many of us have found ourselves in a situation where we bought a call option and we realize that as we approach expiration that we think it's going to take more time. And taking more time requires us to buy an option that's further dated, that requires us to spend more money. That means more risk, right? So today what I want to show you is how you can potentially buy yourself some more time without taking on more risk. So let's say I have this modest directional move. It makes the move, but now I think it takes more time. So what I can do is I can sell my entire trade. I have 10 contracts of the July $100 call option, but because the trade has gone in my favor, it's now profitable, right? So for me to sell the full position now, because the calls are now worth $6 instead of $3, I can bring in a $6,000 credit to buy this to sell my full position. And then what I can do is I can use it to fund the next month's contract. In this particular case, let's say I have to go out to August. I'm going to buy the same $100 call options. Let's say those contracts, because they are now for the August $100 calls instead of the July $100 calls, let's say they cost $7. So what I'm going to do now, because the contract costs more money, what I'm going to do is I'm going to buy fewer contracts. So here I'm going to buy only 8 contracts of the August calls, but here I'm only going to spend $5,600, which means that I'm actually reducing risk, right? Because the net credit on this is actually $400, right? Because I'm getting $600 in credits, I'm spending $5,600, so I'm actually receiving a credit of $400. Now, what that means is I've reduced my total trade, my risk on the original trade from $3,000 down to $2,600. So what I've done is I've reduced my risk from $3,000 to $2,600, and I've bought myself a whole nother month. And the goal here is to buy yourself more time without spending more money. This strategy does many times, it gives you an extension in terms of the target time, if you will. It does decrease your leverage because it generally costs more to buy a further dated contract. It always does. So you can only buy fewer contracts, but what this does is it, generally speaking, will reduce some of your downside risk as well. So what you've done here is you've reduced your risk and you've been able to buy yourself a whole nother month in time. So now maybe by July, you think the stock can maybe hit 112 or 115. So you've bought yourself more time, you've bought yourself more upside, and at the same time, you've reduced your risk. So again, there are different variations as to how you can do this, but this is another example of how you can utilize options to really get what you want, right? And turn your small winners into potentially much larger winners, especially with new information. You might think that, oh, I'm even more bullish now. I just think it takes more time. But at that point, the trade's already going in your favor and you have a lot of options as to how you can achieve that, okay? So if this makes sense to you, please type 7 into the chat window. Perfect, I see a lot of 7s. So lastly, we have an example where, same example, I have a $100 stock. I think it's going to rally to 110. And the stock makes, let's say, a big move to the upside. So I buy 10 contracts of the $100 call option for $3. And I have a target price of 110. So let's say in this particular case, I get a really quick directional move that happens even faster than I had originally anticipated, right? I think it's going to go to 110, but then in a week, it shoots up to 108. Maybe some new information comes out, some unexpected news comes out, really positive news that turns it into even a more bullish play. So you think to yourself, well, the stock's made a big move to the upside. I still have plenty of time left to go. Now I think the stock can go even further. Originally, I thought it's going to go to 110. Now I think maybe it'll go to 120, right? Whatever that is, whatever your new target price is. what you can do here, this is really, again, where you can turn, this doesn't happen all the time, right? This happens fairly rarely, but once in a while it does happen. And this is really where you want to spend your brain cells, is figuring out how do you turn this unexpected good luck, if you will, into a much larger winner. So in this particular case, what you can do is you can sell your entire contract. So the stock made a big move. You can turn your $3,000 investment. You sell all 10 contracts. Maybe the call options are now worth $10, so you collect $10,000 in terms of credit. But because you think it can continue going here, what you do is you buy 15 contracts of a higher call option. So now instead of buying a $100 call, the at-the-monies, you're buying the new at-the-monies, let's say the 110 calls. And let's say those calls only cost $5. So what you could do is not only do you buy 10 contracts, you buy 15 contracts. Because now, and let's say that only costs you, because these are now $5, you can buy 15 contracts of it for only $7,500. So guess what? This net trade actually brings in a credit of $2,500. So what you've done here is you've increased your leverage, because instead of just owning 10 contracts, you now own 15 contracts with the 110 calls. You were able to reduce your risk because you brought in $25 credit to trade this trade. So now initially you laid out $3,000. You've brought in a $2,500 credit to place this trade. Your new risk on this whole trade is now just $500. You're risking just $500 to now own 15 contracts of the same at-the-money calls that you think is now going to reach perhaps 120. You've reduced your exposure with lower risk. You've now increased your leverage with potentially doubling your position sizing or increasing your position size, and you've at the same time reduced your risk. This is really the power of options and what you can do when a trade goes in your favor by reducing risk and playing for additional upside. The vice versa, when a trade goes against you, anything that you're going to do is not going to reduce risk. Anything you're going to do to try to get yourself back to break even is going to increase risk and does the exact opposite of everything that I'm teaching you here. And that's why it's so important that you don't focus your attention on managing your losers, that you simply just don't waste any brain cells on those. Cut your losers. Spend your time figuring out, how do I turn my small winners into huge winners? And that's when you're going to become a much more successful trader. And it's not difficult. It's really not difficult to do. It's just an emotional switch that you need to have internally with accepting the fact that some trades are going to lose, accept that fact that you're going to have some losers and you're okay with taking on a small loss, and then focusing, redirecting your attention on things like this. And I know that that is, I think, it's easy to understand the words that I'm saying. It's very difficult to actually internalize it and practice it. So that's why I want to provide so many examples to help inspire you to think about, well, how do I turn, what seemingly is a small winner into a substantially larger winner? Because this is just for a simple call option that I'm showing you. There are many variations on this if you're trading complex strategies. There are many variations for it if a trade goes a little bit further in your favor. So this is just, again, meant to inspire you, to show you all the different things that you can do to manage a small winner and turn them into substantially larger winners, okay? So lastly, what I want to talk about is a little bit about cover calls and cash secured puts, because these are very different from the perspective of, these are for stock investments, right? Cover calls are for your stock investment, cash secured puts are for your stock investment. These are also two strategies that both strategies actually reduce risk for your equity positions. A cover call reduces the risk on a position that you own, and a cash secured put reduces the risk on a purchase of a stock position. So they are a little different in terms of how you manage them. So I wanted to separate them from all the other ones that we talked about. Before I move on to cover calls and cash secured puts, I just want to make sure everyone understands everything else that we discussed here today. So please type 8 if that makes sense to you, everything else that we've discussed about regarding, switching your mental capacity and your thinking as far as where do you spend most of your time? Do you spend most of your time focusing on where you've lost money and how you get yourself back to break even? Or do you just let those go, take on a small loss, and focus more of your attention on managing your winners? Because that's really where you should be spending your time, okay? So I see a lot of 8s, perfect. So now let's talk a little bit about covered calls and cash secured puts. So cash secured puts are a simple strategy that allows you to acquire the stocks that you own at a discount. For those of you that are brand new to the strategy, we have webinars on this for you to learn more about these two strategies. It's covered in our beginners topics. So if you want to go back to our webinars or recordings, go back to the beginner options master courses. We covered both of these two strategies. But from my perspective, selling a cash secured put has two outcomes before you even get into that trade. And those are the two outcomes that you should be comfortable with when you first get into that trade. So there's really nothing to do to manage a cash secured put, because when you sell a cash secured put, there are two possible outcomes. Either it expires worthless and you've kept your income and you can choose whether or not you sell another cash secured put, or you now own the stock. Those are your only two possible outcomes. If you're not comfortable with either one of those two outcomes or one of those two outcomes, you should not be selling a cash secured put to begin with. So you either are comfortable with it and those are the two outcomes, or you shouldn't be selling cash secured puts to begin with. On a covered call, same thing. When you sell a cash covered call, you should be familiar with what are those two possible outcomes. You should be comfortable with both of those two outcomes. If you're not, you should not be selling a covered call. But when you sell a covered call, there are three possible scenarios. So let's say you own a $100 stock, and let's say you sell a 110 covered call. There are three possible scenarios. The stock can either rally significantly higher, it can move sideways, or the stock can decline. And what I'm going to talk about is basically if the stock rallies significantly higher, let's say it rallies up to 120. There are three possible things. When the stock rallies significantly, what you should really do is, this is really where I see most people panic, right? You sold the 110 call, the stock shoots up well above your stock price. So you're thinking to yourself, oh, I gave up some gains here. What do? I'm taking on an unrealized loss on my covered call. The answer is don't panic. You want to hold on to a cover call until you approach expiration. So because when the stock makes a big move to the upside, guess what? The stock can also, over the next couple of weeks, make a big move to the downside. That's how volatility works. So whenever a stock moves substantially above your strike price before expiration, don't panic, especially if you still have time left. Because number one, by holding onto it, you can extract more time decay or time of the time extrinsic value that you originally sold, because that is yours to keep once you hold it to expiration. You have to remember that your any losses that you have in the underlying on the covered call is going to be hedged with the stock position that you own. So whatever losses that you have, you will make that back on the underlying stock. And you generally want to account for the fact that when the stock makes a big move, it can move back down the next week. So you don't want to lock in a loss, and that is going to come back potentially the next week. So that's why whenever you sell a cover call and the stock makes a big move to the upside, you don't want to panic, and you generally want to hold it until as you get closer to expiration. Now, in the second example, when the stock moves sideways, that is really where we call in kind of your best case scenario when it comes to selling a cover call. This is really where the stock is likely going to, or the cover call that you sold is likely going to expire worthless. You should hold it to expiration, let it expire worthless, and sell another cover call. So that's a simple one to do. Then the tricky one actually is when the stock makes a big plummet. This is really the only time where it makes sense to take action early. Because if you sold a cover call at 110 and the stock drops from 100 down to 90, that call that you sold, which might still have plenty of time left to go, is likely going to be worth next to nothing. So many times if you sold a $1 call option, if the stock was to drop from that 110 to 90, it's now probably worth something like 10 cents or maybe 5 cents at that point. So the rule of thumb here as far as when you might want to buy back a call early, and when a stock drops is really the only scenario where you might want to do something early, is if you can buy back the call that you sold for 20% of the premium that you originally collected. So if you sold something for $1 and you can buy it back now for 20 cents, that's when it's time to make sense. That's when it makes sense to buy that call early and then perhaps sell another cover call, perhaps a 105 or 102, a lower cover call at that point, so that it's still above your break-even price. But that is the only time where it makes sense to make a move early on a cover call. So I just want to make sure everyone understands that. So please type 9 into the chat window if these scenarios make sense to you. Okay, perfect. So I covered a lot of things here today, but I spent a little bit extra time today on the first few slides talking about trading psychology, talking about managing risk, talking about keeping your losers small, because in my opinion, that is the most important lesson to learn before you learn about any strategy, before you learn about any options, before you learn about any technical analysis, even though it doesn't really apply until you've learned those things and until you've made some trades. But it's so important to learn the mindset of how you need to think about managing winners and losers. And keep in mind that the way that we manage winners and losers as beginners is, has been proven through empirical evidence of how human beings manage risk and reward. We do it in counterintuitive. We're not very good at managing risk as human beings. We have to actually learn this. This is something that has to be taught. And that's why I spend so much time teaching that one thing here on this webinar, because it's so important for you to switch your thinking and not thinking about, how do I turn my losers into winners? And more importantly, how do I just cut my losers and keep them small so that I can focus my attention so that if and when I win, I'm able to manage those and turn those small wins into huge wins. So that is the lesson that I hope I was able to teach you here today. And I know I went a little bit over time, but I do find this topic so important that I did go an extra 10 minutes to make sure that I was able to convey that to you guys here today. So with that, I want to thank everyone for taking the time out here this afternoon. I really hope that you guys find this useful in improving your ability to trade in the options market and think about how you manage your positions, because without this, you can really struggle as a trader. And this is really where we draw conclusions or parallels to running on a hamster wheel, where you find yourself very frustrated with trading because, once in a while you hit a stride where you have a few winners, but then it just takes 1 or 2 losers to wipe all of that out. And that's a process that I see a lot of traders, go over and over and over again without really understanding why or how it's happening. And I hope that this was able to illustrate to you how you should think about trading, because when you think about an infinite game and you don't focus on just, do I win here, do I lose there? Because winning here and losing there it doesn't matter in the long run. What matters is how profitable you are in the long run. So once you do that, you stop thinking about winning and losing. You start thinking about, how do I make sure that I keep my losers small? And how do I make sure I stay in the game? Once you're able to change that thesis or that way that you think of how you approach trading, that's really where I think traders stop struggling and really start becoming successful at trading. So with that, what I'll do is I'll open this up for Q&A. If you have any questions, please type them into the chat window. I'll try to spend a few minutes answering your questions here. And keep in mind, for those of you that are brand new to OptionsPlay, if you want to sign up for the free tool, you can sign up using optionsplay.com/TMX, sorry. So Morley is asking, if your stock is called away when it goes to 120, is there a strategy that you suggest? I mean, from my perspective, not really, right? I mean, that's a great scenario. You own the stock that you think is going to increase in value. It increases in value. You should be happy, and you should be happy that you're able to take profit on that. And many times people don't focus on taking profit. People focus on, I could have made another $10. I mean, unfortunately, that's just not how the market works. You're never going to be able to take profit at the very peak. You have to be comfortable and happy with the fact that you were able to take some profits from that. So there's really not much you can do. I mean, by selling a cover call, you're obligating yourself to sell the stock at a specific price. And you should be happy, right? Because most of the time when you sell a cover call, you should be saying to yourself, if I sold my stock at that price, I should be happy. It's only with new information that you are able to go in hindsight and say, I could have made more. But hindsight's 20/20, and you never have that when you initiate a trade. So that's my view on that, Morley. I hope that I was able to answer your question. Jessica's asking, is it even better if we can buy back the call for greater than 20% of the premium collected? No, Jessica, you want to buy it back at zero in the best case scenario, because you sold it, right? You sold it. You want to keep all of it. Whatever you buy it back at, that's what you're giving up. So if you have to buy it back at 20 cents, then you only make 80 cents. If you buy it back at 10 cents, then you make 90 cents. So the less you're able to buy it back for, the better. Nicholas is saying, for a cover call, if the stock rises above the strike price, we should wait to buy back position, even though the dividend distribution before the expiration. So if the dividend distribution is within the last week or two, then you might be at risk of early assignment. That's the only time where I would buy it back early, but otherwise I would wait until the last week. For Aaron, Pasquala, Azim, EP, Gills, Brian, thank you so much. Brian's asking, what if my account size is small? Example, I can only buy 3 contracts instead of 10. That's perfectly fine, Brian. I mean, you don't have to, then you would only sell 1 contract or 2 contracts. No problem. You just want to take partial profits. It doesn't have to be exactly half for you to trade. So that was just an example to give you, taking partial profits. On a cover call, if stock is above the strike price, you still make profits on stocks, and you can let the option exercise on its own. That is absolutely correct. So at expiration, if the stock is above the if it's above the strike price, you don't have to do anything if you feel comfortable selling your stock. Your brokerage firm will take care of that for you. My trading account is so small that I have to risk at least 5% per trade, even trading 1 option contract. So is it okay for me to break the 1 to 2% rule? Ash, if your account is so small that you have to risk more, then obviously there's nothing that you can do on that. My suggestion to you is that at all costs, do everything you can so that you minimize the percentage of your account that you risk per trade. The other thing that you can do if you can't stick to the 1 to 2% rule is to not have multiple contracts open at the same time, right? A lot of times people that stick to the 1 to 2% rule have 20 positions that are all expiring on the same day, open at the same time. That doesn't help either, right? Because then you're still risking 40% of your account at one time, because they all expire on the same day, and all it takes is one bad trading day to wipe out all of your positions. So Ash, if you have to risk more than 1 to 2% of your account per trade, my suggestion to you is be patient. Don't have 5 trades going on at the same time. Wait for one to expire before you open up the next one until you build up your account to a large enough value where you can stick to the 1 to 2% rule. Then you can have multiple trades going on at the same time. Alan, you're very welcome. Steve is asking, on May 26th, I was short-term bearish on XIU because it was trading near resistance. So I placed a bear call spread, sold the 23 calls, bought the 24.5 calls. Given the net premium collected was $42, it was more than 1/5 the vertical width. The suggested exit plan is to cut losses at 75 to 100% if the trade goes against you. If this exit trade is supposed to be placed on expiration date, or do you execute the trade the moment? So you would execute this trade the moment you pass your stop loss thresholds. So here you collected 42 cents in premium. Once you've lost an additional 42 cents, so once the spread that you sold that was originally at 40-cent credit is now 82-cent credit, you should cut your losses on that trade, which I think if you entered this trade on May 26th, you might be close to that at this point. So no, you should not hold this to expiration. As soon as it crosses your threshold of being quote unquote either incorrect, right? Because you believe that it was near resistance and it's going to stay below that resistance. Once it crosses that resistance level, you should have gotten out. Or once it hits your threshold in terms of P&L, you should get out. You should not wait till expiration. Ed is asking, I'm almost ready to buy, just need some courage to buy and sell. Well, Ed, I hope that this gave you a little bit more ammunition in terms of having a plan before you buy and sell. I will say having a plan before you buy and sell is the best way to prepare for buying and selling. That's the best advice that I have for you. When you refer to selling calls, does it mean that you also own the underlying stock or just selling an open call option? Generally speaking, I'm referring to selling a covered call, so owning the stock and selling a call on it. Debbie's saying, I put the question in Q&A. Let's see if I can find that, Debbie. Debbie, I don't see your question in the Q&A. If you don't mind typing in it again, I'm happy to take a look, but I don't see your question, unfortunately. Sanjay is asking, how do we get access to US stocks? So you can access OptionsPlay for the US as well by going to www.optionsplay.com, which I will post a link into the chat window for those of you that want to use OptionsPlay for the US markets. There's a free 30-day trial there. You can sign up for the free 30-day trial, try out the US platform with our education and our trade ideas, and it's all available to you on a free trial for 30 days. Can you explain rolling in the cover call scenario when the price goes high? There's not much to explain other than if the stock exceeds your strike price and you think the stock can continue going, you just want to buy back the call that you initially sold and sell a new call at obviously a higher strike price based on the current price of the underlying stock. So a rolling is just closing out your existing position and opening up a new one. Brian's asking, if the premium on a cover call is too low, how can you generate income? So the reality is that you can't sell a cover call on every single stock. Not every single stock is suitable for selling cover calls. And in some stocks, maybe on BlackBerry, I'll just take a look here real quick. You know, many times on the low price stocks, it's hard to find a cover call. So yeah, so here, you know, we're not able to find a cover call, you know, with a short-term aggressive or short-term optimal preferences. You have to get very aggressive. So not every single trade you're going to be able to sell a cover call on, Brian. Dean is asking if a cover call moves lower rather than buying back the call at 20% of the premium, can you not just let it expire? You can, but then you're basically letting yield, you know, if you've already extracted the yield from the call, why wait another 3-4 weeks for you to capture the extra 5 cents or 10 cents? Why not buy it back and sell another one for maybe another $1 and capture another 50 or 40 or 50 cents in the next 2 to 3 weeks? So that's why you want to buy it back early. Why not just let a cover call for a stock whose price is declining just expire worthless? I think that's along the same question. And again, the reason is just to extract more yield. You can, but you're just giving up yield to do so. If a stock increases, this is in conjunction to the cover call example, if the stock increases to 120, can you roll forward and buy back cover call and sell another at 120? Yeah, absolutely. That's exactly what a roll is. Frank is asking, suppose you roll up for a credit and stock turns down. How do you manage? Well, Frank, that's always the scenario that can happen, and that's what we're trying to prevent, right? Is that if the stock goes in your favor and then starts to go back, if you didn't roll, you would lose most of the premium that you originally paid. Now, this doesn't prevent the stock from going lower. It's just that if it goes lower, you're now risking substantially less capital, right? Because you took it in a credit. That means that you're reducing your risk. And the goal is to maintain your potential upside, but do so in a way where now your risk is reduced. So that's really what it's for. When will stock exercise call option? I'm not sure I understand that question, Siva. If you're referring to a cover call, it will get exercised at expiration. If you're talking about a long call, you can exercise at any point. Generally speaking, it just doesn't make sense to exercise it until you get to expiration. Debbie's asking, on your options liquidity list, under the earnings date column, can you please tell me what the bracketed number means? RY's August 26th with a bracket of 78. What does 78 mean? 78 is the number of calendar days until the next earnings date. So many times we think about option expiration days in terms of number of days to expiration. So that's why we have the number of days to the next earnings date. Why would you buy back or call at 20% of the premium collected when you could just keep the full premium collected? Because to get the rest of the premium, you have to hold on to it to expiration, right? And things can happen between now and expiration. The stock can jump between now and expiration, or it can keep going further. The goal is that you want to extract more yield, right? Yes, you can hold on to it for another 3 more weeks and collect another 10 cents, Well, why do that when you can buy it back for 10 cents and sell a new cover call, maybe just that expires in another 3 weeks for another $1, right? So why only go for another 20 cents when you can go for another 80 cents? That's the whole reason why you want to roll early. Sanjay is saying, I sold a 150 put on Hertz for 40 cents, declared bankruptcy, was put the stock, rallied to 550. Now what to do given it's still in bankruptcy? Sell the stock, sell a cover call, buy more. Sanjay, hard for me to answer that until I look at Hertz. I really don't know a lot about the whole bankruptcy. I'm sorry, but I can't comment on that unless you send me an email at info@optionsplay.com and I can spend a little bit more time researching that. With that, I've spent quite a bit of time here today. I spent a lot of your time. So again, I want to thank everyone for taking the time out here this afternoon to participate. I really hope that this was useful in helping you guys better frame your mindset as to how do you become a successful trader, because this is by far the most important topic, in my opinion, for any trader to learn before they spend their time focusing on strategies and calls and puts and deltas and all of those things that are very important, right, for increasing your chances of success. But none of that really matters if you don't first have the right mindset. So I hope that this was useful in helping you gain a better understanding of that. And like I said, for those of you that are really interested in learning it, go and Google finite versus infinite game. You would be fascinated by the things that you can learn. For all of you that are interested in learning these things, it's a very, very interesting topic, and I think can be useful in many other aspects of your life outside of trading. So thank you so much. We will send you the recording here with the slides as soon as we're able to in a few hours. And I hope that you guys found this useful, and I will see you guys here in the next earnings or the next educational event. So thank you so much. I hope you guys have a great evening and I'll see you guys next time.